Hello everyone, thanks for joining us here on Horizon. Well, a capital gain is certainly something we all wish we could have. It's the profit made on the sale of a large ticket item that can range from property to stocks or dividends. Now, during the past election, President Obama campaigned on the wealthy paying more in taxes, and an increase in the capital gain tax rate is one way that could happen. Joining me now is our Andy Barth.
Well, Rob, the tax code has long favored investment income over the money we get in our paychecks. But today's capital gain rates now sit at 15% and are the lowest they have been since the 1930s. Now, President Obama campaigned to raise those rates, but only for the wealthy. Under his plan, those earning more than $250,000 a year would see any capital gains taxed at 20%, and dividends would go back to being taxed as ordinary income, more than doubling the current rate.
You see this?
Oh, let me guess.
Meet Fred and Eleanor.
No, it's worse. Look.
Two actors in a multi-million-dollar ad campaign opposing possible increases in taxes on dividends and capital gains.
Our dividends would more than double.
Anytime you sell anything you own for a profit, for more than you paid for it, that's a capital gain.
Dr. Gary Simpson is a professor of finance at Oklahoma State University and says higher rates on capital gains and dividends will cause some people's tax bills to go up.
If you sold a share of stock, the tax on that now would be 15%. Now what will happen, and what a lot of controversy is that in 2013, the end of 2012, that will be taxed as ordinary income.
Which would double the current taxable rate. And while retirees living off investments may be the focus in the campaign against the rate increases, it is Wall Street that may feel the real pinch. Currently, the top 0.1% high-income earners receive more than half of today's tax benefits. Among these super rich are Wall Street traders who enjoy the lower capital gain tax rate of 15%.
The big argument, of course, with the carried income is, of course, usually you're looking at wealthy hedge fund managers, wealthy private equity investors. Essentially, the gains that these people earn, it could be argued that it's labor income because in some cases they have invested maybe quite a bit of money, but it's a small percentage of the total investments in a company.
Yet it is on Main Street that some fear a higher rate may slow the economy. Entrepreneur and business owner Anthony Mulligan says if businesses have to pay more in taxes, they won't invest in hiring more employees.
If we didn't have that margin from the capital gains difference to start the business, we would have probably done something, but it would have been really small, and it would have probably been more of like a consulting business where I would have probably spent time here and there giving people advice and charging them a fee for that. But instead, we just jumped right in and went into business and hired people.
Yet raising the rates on capital gains and investment income would bring in roughly $240 billion over a decade.
It's a big part of our retirement.
No, it's dividends too. The rate on our dividends would more than double.
But we depend on our dividends to help pay our bills. We worked hard to save.
The President and Congress have got to work together.
Now, a common debate is why not adjust capital gains for inflation? Well, here are some numbers that explain why. Let's say you invest $10,000 in a friend's startup company. It struggles for a decade, but in the 10th year, it takes off, and your share catapults in value to $110,000. You then sell that share and pay a capital gains on $100,000. Now, at the old capital gains rate of 28%, you would pay $28,000. Now let's imagine that inflation begins to rage and the dollar loses half its value. Your $100,000 gain would only be worth $50,000. So you would be paying $28,000 on a gain that's only worth $50,000 in real money.
So exactly how many people could this affect, Andy?
Well, Rob, less than 20% of taxpayers even report paying on capital gains and even less on investment income.
All right. Thank you so much, Andy.
You're welcome, Rob.
While raising rates on investment income could bring in close to $250 million in new tax revenues over the next decade, it hasn't been that way the past couple of years. Americans made fewer profits from their investments during the recession, and as logic follows, the federal government brought in way less from capital gains taxes. $137 billion were collected in 2007, and that amount was down to just $37 billion in 2009. When we return, I'll tell you why I have come to fear the beard.